Walk into a shop today, place a piece of plastic against a machine, and you can leave with goods you have not yet paid for. The merchant may never have seen you before. They do not know your family, your employer, or whether you have broken promises in another town. Yet, within seconds, a distant institution tells the seller to trust you. Now remove the card, the bank network, the credit score, the computer, and even the reliable supply of cash. You still need food before payday. You still need seed before harvest. A craftsman still needs iron before he can sell the tools made from it. How could anyone buy now and pay later when a seller had no instant way to discover whether a customer was honest, solvent, or already drowning in debt? The answer was written in ledgers, carved into sticks, guaranteed by neighbors, secured against crops, and carried in the memories of shopkeepers. Long before credit cards, ordinary commerce ran on personal promises, but every promise forced the seller to make a dangerous calculation. Give away the goods today, wait months for payment, and hope that the customer returns. If the calculation was right, credit created a loyal buyer and a profitable sale. If it was wrong, the ink in the ledger became a record of money that would never arrive. This was credit in its most direct form. A lender may advance money or fungible goods in a separate transaction. Merchant credit arose when a seller delivered flour, cloth, tools, fuel, or furniture, but deferred the purchase price. The shopkeeper was not merely selling a product. The shopkeeper was also financing the customer. The price, the waiting time, and the risk of default were bundled into one transaction. That distinction matters because credit was not invented as a luxury for people who wanted more than they could afford. It often appeared because the timing of income and the timing of survival did not match. A farm might produce money once or twice a year, but a household needed salt, candles, shoes, and food every week. A sailor might be paid only when a voyage ended. A laborer could wait for an employer to settle wages. A small producer might own valuable goods in progress but possess almost no coin. Picture a farmer in an early modern or colonial town entering a general store at the beginning of spring. He needs a new iron blade, seed, lamp oil, and enough provisions to carry his family through planting. His purse cannot cover the bill. The harvest is still underground. The merchant could refuse the sale and keep the inventory. Or the merchant could open a ledger, write the farmer's name on a page, list each item, and wait until the crop was sold. No interest rate needed to be spoken aloud for the transaction to have a financial cost. The credit price could be higher than the cash price. A discount could be offered to anyone who settled immediately. The merchant might demand repayment in produce at a favorable valuation, add fees after a deadline, or simply price every item high enough that reliable customers helped cover the losses created by unreliable ones. Credit could look free while its cost hid inside the goods. The merchant's decision began with information. Was this customer known in the town? Did he own land? Had he paid last season? Was his farm productive? Did his family have a reputation for keeping promises? Had another shopkeeper quietly stopped serving him? In a small community, the human being behind the debt was the credit report. Reputation became a form of collateral. A customer who failed to pay did not merely lose access to one shop. News could spread through neighbors, relatives, guild members, churches, taverns, and markets. Future sellers might demand cash, business partners might withdraw, a guarantor could be asked to pay. In communities where people repeatedly traded with one another, exclusion from credit could be more damaging than a single legal penalty. That made trust economically valuable, but it also made credit intensely unequal. A landowner with respected relatives might receive months of generous terms. A traveller with the same income but no local history could be rejected. A servant, a labourer, a married woman constrained by a system such as English coverture, a religious outsider, or a member of a despised group could be judged through prejudice rather than evidence. Before numerical scores, credit decisions could be flexible and humane, but they could also be arbitrary, intrusive, and discriminatory. So merchants created limits. A familiar customer might be allowed a larger balance. A new customer might need a guarantor. A farmer's deadline could be tied to harvest. A sailor's account might wait for the ship's return. A craftsman could repay with finished goods. The terms were designed around the rhythm of the customer's income because demanding money before money existed guaranteed failure. The ledger made these relationships visible. On one side were goods taken, services received, or cash advanced. On the other were coins paid, crops delivered, labor performed, goods returned, or claims transferred. Accounts could remain open for months, with many tiny purchases accumulating before settlement. The final balance was not always paid in the same thing in which it had been measured. One English dispute from 1580 reveals both the usefulness and danger of that book. Agnes Moore bought kersey cloth and lining worth 5 shillings and 2 pence. She paid 22 pence immediately, while 3 shillings and 4 pence entered the seller's debt book. Months later, when payment was sent, the merchant's agent claimed that 4 shillings and 4 pence remained. The ledger preserved a delayed sale, yet control of the record also created room for conflict. A merchant might measure a debt in a money of account even when little matching coin changed hands. Payment could arrive as tobacco, grain, animal hides, a note from another person, or an offsetting obligation. If the shopkeeper owed the customer for hauling freight, that amount could be subtracted from the store balance. Credit allowed commerce to continue even when physical money was scarce. The roots were ancient. At Kultepe in Anatolia, old Assyrian merchants sold imported tin and textiles on credit and preserved obligations in clay tablets secured by seals and witnesses. Other tablets recorded silver loans due partly at the next harvest. The two arrangements were not identical. One deferred the price of merchandise, the other advanced a fungible asset. Together, they show how writing made value today exchangeable for an enforceable claim on value later. In medieval and early modern markets, the same need produced account books, sealed acknowledgements, private tallies, and written promises. England's best documented tally system served the Royal Exchequer. Notches recorded receipts or debts, and the wood was split so matching halves could later authenticate the claim. Tallies were paired evidence, not wooden credit cards. Long-distance traders used bills and correspondence, while a village shop still depended heavily on repeated contact and local knowledge. Credit was not a side activity at the edge of a cash economy. In many places, it formed a chain. A distant supplier allowed a wholesaler time to pay. The wholesaler extended terms to a local merchant. The merchant allowed customers to run accounts. The customer promised to settle after harvest. One bag of grain at the end of this chain might support several promises above it. This multiplied trade because no participant needed to wait until every previous sale had been settled in coin, but it also multiplied fragility. If weather destroyed the harvest, customers might fail to pay. That could leave a shopkeeper unable to meet obligations to a wholesaler, who might then delay an importer. A local crop failure could climb through a network of ledgers and become a commercial crisis far away. The merchant therefore sold two scarce things: inventory and time. Inventory disappeared the moment it left the shelf. Time was consumed while the bill remained unpaid. During that waiting period, the merchant still had to replace stock, pay workers, maintain the building, and satisfy suppliers. A profitable sale on paper could create a cash shortage in reality. This is why a shop full of customers could still fail. Suppose a merchant sold $100 of goods for $120 payable after harvest. The $20 margin looked attractive. But if one customer in 6 defaulted completely, the loss could erase the entire margin. If the merchant had borrowed to buy the inventory, the cost of waiting reduced profit further. Credit increased sales, but only if the price and repayment rate covered the risk. Collection was part of the business model. A polite reminder might come first, followed by demand to a guarantor or refusal of further purchases. Depending on the place and period, remedies could range from local suit and seizure of pledged property to imprisonment or debt bondage. These penalties never formed one universal ladder, but every creditor needed some answer when trust failed. The threat encouraged repayment, but punishment could defeat the creditor's own purpose. A farmer locked away could not harvest a crop. A craftsman stripped of every tool could not earn money. Experienced creditors often preferred restructuring to destruction: more time, smaller installments, partial payment, or a new promise supported by security. The creditor wanted discipline, but ultimately wanted value, not revenge. Religious and legal restrictions on interest did not eliminate credit, but their rules varied across jurisdictions and traditions. Restrictions encouraged some merchants to structure returns through deferred sale prices, exchange, partnership, storage, or compensation for genuine risk. Authorities did not automatically accept every device. Some contracts were condemned as disguises for interest. The price of time survived, but its lawful form remained contested. Credit also created loyalty. A customer with a running balance was less likely to move to a competing shop, especially if the old merchant knew his history and the new merchant did not. The account could be both a convenience and a restraint. In some merchant planter or company store systems, accumulated debt gave the creditor influence over what a customer bought, when produce was sold, and which price was accepted. In parts of colonial America, where coin could be scarce and incomes were often seasonal, book credit became central to trade. Merchants recorded purchases as debits and payments as credits. Accounts could be settled with currency, agricultural products, labor, or promissory notes. In the Chesapeake tobacco economy, a planter's future crop could stand behind present consumption, linking imported goods to an Atlantic market and to the enslaved labor on which much of that crop production rested. This system depended on a merchant's judgment, but judgment had limits. A friendly customer could owe money in several stores without any seller seeing the complete picture. A person could move. A rumor could be false. A prosperous coat could conceal an empty purse. Every extension of credit contained an information gap, and the debtor usually knew more about his ability and intention to pay than the creditor did. As towns expanded, the old method became harder. A shopkeeper could remember the habits of 50 families. A department store could not personally know 50,000 customers. Urbanization created more buyers and greater anonymity at the same time. The market for credit could grow only if trust became recordable, transferable, and faster to verify. Businesses responded by building information systems. Merchants exchanged references. Credit reporting firms collected reports on commercial borrowers. Retailers created credit departments that asked about employment, residence, income, property, and previous accounts. Clerks turned personal lives into files. The question, "Do I know this person?" slowly became, "What does the record say?" This did not remove human bias. It organized it. Reports could include gossip, moral judgments, marital status, neighborhood, race, and other facts that had little to do with whether a particular bill would be paid. A centralized record could rescue a trustworthy stranger from anonymity, but it could also spread one mistake or prejudice farther than village rumor ever traveled. Industrial production created another pressure. Factories could manufacture sewing machines, stoves, furniture, farm equipment, pianos, and eventually automobiles faster than households could save enough cash to buy them. Producers faced a paradox. Millions of people wanted the goods and could make small payments from regular income, yet could not pay the entire price today. Installment selling solved the timing problem. The buyer made a down payment, took the product, and paid the rest in scheduled amounts. Unlike an open shop tab filled with flour and candles, an installment contract was usually tied to one durable object. The product itself could help secure the debt. If payments stopped, the seller or finance company might repossess it. The economics were powerful. A household did not need to wait years to use a machine that could save labor or provide income. A manufacturer reached customers far beyond the small group able to pay cash. A dealer earned a margin on the product and could earn more through financing. Regular payments transformed future wages into immediate demand, allowing factories to sell at mass scale. But the low monthly payment could disguise the total price. A customer focused on affordability this week might ignore how much would be paid over 2 years. Fees, insurance, and financing charges could raise the cost sharply. Repossession protected the creditor, yet a used item might be worth much less than the remaining balance. The lender still needed a down payment large enough, a price high enough, or a default rate low enough to survive. Credit changed from an accommodation into a sales engine. Instead of waiting for customers to request time, retailers advertised time as part of the product. Take it home today became more persuasive than save until next year. The future income of the buyer became one more resource businesses could compete to capture. By the early 20th century, large merchants had a record-keeping problem at the counter. A recognized customer could say, "Put it on my account," but the clerk needed to locate the correct file, copy the correct details, and avoid charging the wrong person. A handwritten name was slow. A familiar face did not work in every branch. Retail credit needed a portable identity. Stores and other businesses experimented with paper cards, metal tokens, and charge coins bearing customer or account numbers. These devices were not universal money. A token from one merchant usually meant nothing to another. Its purpose was to identify an approved account quickly, reducing clerical work and signaling that the holder had already passed the store's test. The Chaga plate, developed in 1928 and used mainly from the 1930s through the 1950s, mechanized this process. It was a small metal plate with embossed identifying details. A clerk could place it into a device with a sales slip and produce an imprint instead of copying the customer's information by hand. The plate made charging faster and reduced errors, but it did not create a national credit network. It was a better key to a store account. Department stores, oil companies, hotels, railroads, and airlines issued their own cards or account credentials. These programs encouraged repeat business. A driver who carried one oil company's card had a reason to choose that company's station. A traveler with a hotel or airline account could avoid carrying large amounts of cash. For the issuer, convenience became a tool for loyalty. Yet, wallets filled with separate promises. One credential worked at one chain, another at a gasoline network, another at a store. Each issuer recruited customers, checked credit, carried receivables, administered billing, collected payments, and absorbed fraud within its own closed world. The customer had credit, but it was not portable across the whole economy. The next breakthrough was not really the material of the card. It was the creation of an intermediary between buyer and seller. Instead of every restaurant deciding whether to trust every diner, a separate organization could approve the customer, persuade many restaurants to accept the same account, pay the merchants, and send one bill to the customer. Diners Club, launched in 1950, became a famous example of this model. Built first around restaurant spending, it soon expanded through travel and entertainment, and balances were generally expected to be paid in full. The customer gained acceptance at multiple establishments. The merchant gained access to customers who could spend without cash. The card company stood in the middle and earned revenue from the system. That middle position changed the transaction. The restaurant no longer needed a personal relationship with the diner. It needed confidence that the card issuer would settle the charge. The issuer, not the individual restaurant, maintained the customer account and pursued payment. A merchant could surrender a percentage of the sale in exchange for more predictable settlement, more customers, and relief from direct collection. The card network was selling trust in both directions. It told the merchant that an approved customer's promise could be accepted. It told the customer that participating merchants would recognize the same credential. The more merchants joined, the more useful the card became to customers. The more customers carried it, the more difficult it became for merchants to refuse. Credit acquired a network effect. Banks saw an opportunity larger than restaurant bills. They already held deposits, evaluated borrowers, moved payments, and possessed capital. If a bank issued one account usable at many unrelated merchants, it could separate the business of selling goods from the business of financing buyers. Bank of America launched Bank Americard in California in 1958. Other bank card programs appeared, failed, combined, or expanded. Building the network was difficult. Banks needed enough cardholders to interest merchants and enough merchants to make the card useful. They had to process paper slips, detect stolen cards, authorize large purchases, collect overdue balances, and prevent losses from overwhelming revenue. Scale required cooperation beyond one bank. Bank of America began licensing Bank Americard to other banks in 1966. Competing banks formed Interbank that same year, creating the network later called MasterCard. Bank Americard became a separate organization in 1970 and was renamed Visa in 1976. As cards crossed local boundaries, common rules for authorization, clearing, and settlement became as important as the accounts themselves. Some early campaigns mailed usable cards to people who had not requested them. The strategy produced rapid scale, but also confusion, fraud, and bad debt. A card could be lost, stolen, or delivered to the wrong address. Competition encouraged issuers to expand before their controls were ready. The modern convenience was born through expensive experiments, not one perfect invention. Revolving credit completed the transformation. A traditional charge account might require the full balance each month. A revolving account allowed the customer to pay part, carry the remainder, and pay finance charges. The merchant paid a discount to the card system. The issuer could receive a share through interchange and earn interest from revolving balances. For the consumer, one card became a standing line of purchasing power rather than a single delayed bill. This portability was something a local shop tab could rarely provide at comparable scale. The farmer's ledger worked because one merchant knew one farmer. A general-purpose card worked because thousands of merchants agreed to accept the judgment of an issuer they trusted. The customer's reputation no longer had to be rebuilt at every counter. When a merchant extended book or installment credit directly, that merchant owned the receivable, waited for repayment, kept the records, and absorbed the default. Under a bank card system, the seller could transmit the transaction, receive payment minus a fee, and return attention to selling. Much of the financing moved off shopkeepers' ledgers and onto the balance sheets of specialized institutions. That separation changed who could measure profit. Under direct store credit, product margin, and financing cost occupied the same account. A card system divided them. Retailers studied sales, issuers studied balances, late payments, and defaults. The merchant discount, the issuer's interchange revenue, a borrower's finance charges, and any applicable annual or late fees could now appear in different places. Specialization lowered some costs but made the full price of credit harder to see. That fee was not free money. Merchants could incorporate payment costs into prices, meaning cash customers might indirectly share costs created by card users. Card acceptance could increase sales, but refusing cards could drive customers elsewhere. Once the network became large, participation could feel less like a choice and more like an admission price to modern commerce. Cards also changed the geography of trust. A stranger could arrive in a distant city and make a purchase without asking a local acquaintance to guarantee him. Travel became easier. Cards later made remote payment easier for mail order and eventually online commerce through standardized account numbers and authorization. Credit escaped the village, then escaped the physical store. But something was lost with distance. A village merchant might know that a normally reliable family had suffered an illness and grant extra time. A large issuer saw an overdue account. Personal flexibility gave way to rules designed for millions of customers. Those rules could be more consistent, yet a consistent system could be consistently unforgiving. The card did not eliminate the old problems of credit. It relocated and amplified them. The issuer still had to judge who would repay. The honest customer still helped cover losses from default and fraud. Easy access could tempt people to spend future income several times over. When many issuers offered limits independently, a household could build debts no single shopkeeper would ever have permitted. Data became the new reputation. Applications, payment histories, outstanding balances, and credit reports allowed strangers to be evaluated at scale. As computerized reporting and scoring spread from the 1960s onward, statistical models promised faster and more objective decisions than a shopkeeper's intuition. They widened access for many people who lacked the right family name or personal connection. Yet the variables chosen, the histories recorded, and the errors left uncorrected could still reproduce exclusion behind the authority of a number. The fundamental economic trade remained unchanged. Credit moves purchasing power from the future into the present. That can be productive when a tool earns income, A necessary repair preserves work, or timing bridges a temporary gap. It can be destructive when high costs compound, income fails to arrive, or present consumption leaves the future with too little room to breathe. Credit cards did not invent buying now and paying later. Clay tablets had recorded future obligations. Shopkeepers had filled ledgers with household tabs. Farmers had settled after harvest. Stores had offered installments, tokens, and metal plates. Each system had already discovered that a promise could function like purchasing power. What the card changed was the scale and ownership of that promise. It standardized identity, connected unrelated merchants, centralized record keeping, accelerated settlement, and transferred much of the financing from sellers to specialized issuers. A private relationship became a truly portable network. Before the card, the decisive question at the counter was, "Do I trust you?" After the card, it became, "Will the system authorize this?" The old merchant studied a face, a family, a field, and a page in a ledger. The modern merchant waits for a signal. The signal feels instant, but hidden behind it is the same ancient wager. Value leaves the seller today because someone believes value will return tomorrow. Every swipe, tap, and account number is a faster version of the promise once written beside a farmer's name. That was the